There is a growing feeling that Europe is reaching a T-junction in its roadmap. Up until now, over the crisis of the last few years, Europe has kept together by a series of actions that have tried to smooth the pathway for closer EU integration. However, the way that economies are beginning to blow apart and putting pressure on individual sovereign states indicates that further action in the way that we've seen in the past is now going to be inappropriate to market needs, and it feels like either we're coming to a point where Europe has to come together very strongly or indeed decide that it has to fall apart. That is the sense I think that the markets are working towards at the moment, and clearly as those tensions rise, we're starting to see that manifest itself in a number of the charts that we've been looking at, admittedly over the last few weeks and months, but the stresses are quite clear to see. So let us first of all take a look at the euro. The euro has really set off now on quite a concerted trend to the downside. This is the euro versus the dollar, and just in the course of May we can see that it's moved from a level of 132 down to 123, so quite material moves that we're seeing in the currency at the moment. And the question mark is for European holders is that in the very short term we are going to see actions which will have ramifications for the long term, and that risk appetite has come right out of assets associated to the euro. So keep an eye on the currencies, because the currencies to some extent are telling a little bit more of the story at the moment than the stock market. The stock market has one eye on this, and one eye obviously on corporate equity valuations. It's the currencies that I think look quite interesting. Of course, it does continue to manifest itself in interest rate costs for those peripheral countries, and some of the countries here that I'm highlighting, this is Spain and Italy. These two countries matter, of course, by virtue of their size. These are the countries that will inevitably, I think, come to a point of requiring action and support. The question mark is whether or not Germany and other stronger North European countries have got the wherewithal to be able to support these countries, and I suspect that is a question that's going to be asked and answers required in the course of the near term. So those rates continuing to push up there. Where the money is all heading, these are the charts of where the money is heading. This is money that is heading into the very much the safe haven asset classes of US Treasury. The chart I'm showing here indicates the yield that investors are prepared to accept. They are continuing to accept lower and lower yields on the money. It really is a case of just wanting to keep money safe and on the sidelines for the moment, rather than participating in these current trends. On the equity markets, the Spanish market of the IBEX continues to be a feature. It's now down approaching 30% for the year to date, and this level of around 6,000 on the IBEX takes it back to 2000 and 2009 levels, achieved at the sort of depth of the dark days of the recession at that time. So clearly a lot going on in Europe, and these charts just tend to suggest that we're moving now uncontroversially to a position of requiring some sort of answers. There's no doubt that a lot of this financial stress that is impacting the system is impacting on the real economy. This chart of the commodities indicates how quickly commodity prices are coming off at the moment. Europe is having an impact on commodity prices, but the question mark is being asked, is it now impacting on the US market and indeed on China on a slowdown? This index is a conglomeration of effectively hardcore assets, including oil, and we can see here the way that the market has retreated since March. That index level there, as can be seen, was down from sort of 320, 330 to an index level of 270. So material moves in commodities at the moment. One area that I do think is going to become more of interest, it's been kept out of the news up until now, but I think the UK may be in for a tougher time. We have just heard statistics from the UK regarding orders received, purchasing managing index This number was anticipated to be coming in at around 49, and it came in at 45. It has meant that sterling has seen a 7 to 8% retraction against the dollar in the space of just 1 month. And this level here of around 152, 153 is quite a hardcore support line, which has been in place for about 2 years. If we were to see that trend continue, I suspect that the UK's own economy is going to become increasingly in question. And that, again, I'm seeing it more and more in the corporate earnings. So if we take a look at Kingfisher and Marks and Spencer, the share prices of both have generally been declining recently, but it's more a case of what they've been saying to the market. Kingfisher has seen in the last 13 weeks a 10% decline in its UK sales. Now, at the moment, the argument can be said that that was a weak quarter for them anyway, and indeed the weather during April had an impact. But at some point, the excuses of weather are going to run a little bit thin with investors. So we're seeing 10% decline there. Marks and Spencer, that they haven't said anything, but the rumour that's been circulating around is that the women's wear side has seen a near 20% decline in like-for-like sales. There's a picture emerging here of the UK economy possibly in the last 2 months having taken a pretty sharp decline, and the question mark over the forecast for the UK economy for growth of this year, albeit extremely modest, but more importantly a 2% growth for 2013. I suspect that we may be looking to revise those down, so that may weigh again on sterling in very much in the near term. Just to perk up the conversation, the one stock that has continued to sort of trace towards its high levels and all-time high levels is Intercontinental Hotels Group, very much into the international flow of things. So the UK market, it's exposed to the London market, which is extremely strong for hotel reservations at the moment. But the two things are really happening with Intercontinental Hotels. One is that they have a new activist shareholder on the register, and secondly, there have been rumours that I've read this week of consolidation in the global hotel market, which could mean Intercontinental appealing to an international audience. So it goes to show that whilst there's a lot at the macro level that is taking place at the moment, and investors really do need to be aware about the macro back picture, there are stocks such as Intercontinental that are hitting all-time highs. So stock picking does appear to be so relevant in this market.